I want to welcome you to Financial Training for Business Owners. Today, we'll focus on the various options you have for increasing your revenue. Here's what we're going to review today. We'll focus on the 6 options you have for increasing your gross revenue. We'll show you how to find your business's break-even point. And finally, we'll show you how to get your accounts receivable under control. Throughout this session, we'll be reviewing this standard P&L statement template that we covered in detail in a previous session. As you can see, it consists of just 7 basic sections: revenue, COGS, commonly referred to as cost of goods sold, gross profit, which is calculated by subtracting your COGS from your revenue, gross profit percentage, which is calculated by dividing your gross profit by your revenue, overhead, which represents the bills you have to pay every month, net profit, which is your gross profit minus your overhead, and net profit percentage, which is calculated by dividing your net profit by your revenue. As we previously explained, there are only 3 numbers you really need to focus on in any P&L statement. They're the ones highlighted in red: revenue, COGS, and overhead. The reason these 3 are so important has to do with the simple fact that these 3 are the only numbers in your P&L that you can directly impact. The remaining 4 numbers are all determined by these 3. You find gross profit by subtracting COGS from revenue, and then dividing that number by the revenue gives you the gross profit percent. When you subtract your overhead from your gross profit, you find your net profit, which you then divide by revenue to determine your net profit percentage. So, the 3 numbers you can directly impact, and the ones we're going to focus on to help you make dramatic financial gains with 0 cost, are revenue, COGS, and overhead. We then discussed the power of exponential growth. In this example, if we could impact these 3 areas by 5% each, meaning we increase our revenue by a meager 5% and lower our COGS and overhead by 5%, we would generate an additional $27,000 in net profit, and at 0 cost. So now that begs the question, how can we increase revenue and lower our COGS and overhead? Well, the good news is there are multiple ways to impact each of these 3 areas. But for today, let's focus solely on the best ways to increase revenue. There are 6 foolproof options to consider. Your first option for increasing revenue is to increase your price. Now, the last time most small business owners raised their prices was on the 12th of never. Seriously, most are scared to death that any price increase, no matter how small, will lead to a mass exodus of all their customers. There's an excellent chance you feel the exact same way. But have you ever taken a few minutes and run the numbers to see if a price increase will hurt or actually help your business? Well, let's do that now. Let's say you sell a widget for $100 and your cost of goods sold is $70. You decide to increase that price by 10% to $110. So ask yourself, will that small increase really lead to a loss of customers? Well, here's the reality. Yes, a few will leave, but they're most likely your biggest price shoppers that show no loyalty or patronage to your business in the first place. If they can save $1, they will head straight for your competition first chance they get. But even though there will be some customer attrition, to what extent? That business is now making an additional $10, and all of it is profit. Now that's a 33% profit increase on a 10% price increase. For this business to make $1,000 in profit selling their widgets at $100 each, they would need to sell 33.3 widgets. But by increasing their price 10%, they only need to sell 25 widgets. That means that just to break even, this business would have to lose 25% of its customers over a measly 10% price increase. That will never happen. Of course, don't just run out and raise your prices willy-nilly. Err on the side of caution and test the increase on a small scale to gauge your customer's reaction. But the bottom line is simple. There is no faster or easier way to generate additional revenue than to increase your prices. Run your numbers and find out for yourself how many clients you could lose with a small price increase and still break even. And consider the fact that if you did just break even, you would still be ahead because now you're making the exact same revenue as you were before, but with dramatically fewer customers. Now, option 2 for increasing revenue is to sell more stuff. There are several options available to help you increase sales. First, you can create and implement a marketing program. This is almost always the first choice for most business owners. And believe it or not, in most cases, it's the least effective. Marketing is tough these days, mainly due to market saturation. I'm sure you will agree that all of us are literally bombarded with daily marketing messages. Most experts say it's around 3,000 messages per day. If you watch TV today or listen to the radio on your way to work, can you name just one ad you saw or heard? Most people can't. If you check the stats, most buyers don't reach a buying decision until around the 7th point of contact. So how many times do you contact your prospects? And if you do contact them, are you asking them if they're ready to buy what you sell? Or are you providing them with decision-making information that explains to them why they would be an absolute fool to buy from anyone else but you? The latter is the key to effective marketing, but few business owners understand this simple marketing fundamental. The bottom line is this: if you're a startup, then marketing is essential to get your business off the ground. Otherwise, focus on the following options first, and then begin to implement a well-designed marketing campaign that includes a well-written and highly compelling follow-up campaign that continues to nurture your prospects after they indicate their initial interest in what you sell. That's what it takes these days to make marketing work for your business. Now, if you want new customers, joint ventures should be at the top of your list. Joint ventures involve 2 or more businesses that decide to form a partnership to share markets or endorse a specific product or service to their customer base, usually under a revenue share arrangement. The key to creating successful joint ventures is to find partners who service the exact same type of clients that need or want what you sell. Here's how to set up a joint venture relationship. Make a list of every product or service that people might want or need before, during, and after they use your product or service. Then make a list of those businesses that provide these products or services that are used before, during, and after. Now identify the most likely businesses that you could approach by letter or in person to make a deal. And finally, contact each business with a well-crafted letter or a personal visit. Continue to approach appropriate businesses until you find at least one that will help your bottom line profits grow at least 5%. Next up, implement an upsell cross-sell strategy. When you go to McDonald's and the person behind the counter asks if you would like your meal supersized, that's upselling. When that same person then asks if you would like an apple pie to go with your supersized meal, that's cross-selling. Upselling means offering a higher grade or quality or size of the item that the customer may be interested in at the point when the customer is ready to buy. Cross-selling means offering other products or services which complement the item the customer is interested in at the point when the customer is ready to buy. Now, here's what most business owners don't realize. 34% of prospects will buy additional products or services at the time of their original purchase if they're asked to do so. Most businesses never ask them, and they lose out on this lucrative opportunity to dramatically increase their revenue. Now, follow this up with a downsell strategy. Downselling means backing off from your original offer when your potential customer appears to reject it, offering something less expensive or of lower quantity. Then once you establish the buying relationship, upselling and cross-selling at a later date. The key idea is to get the buyer to enter into a long-term relationship by at least persuading them to buy something. There are 2 questions to which you will want to prepare a ready and compelling solution. Answer these questions ahead of time, and you will see your revenues and profits grow. What else do my customers want if they reject my initial offer? And what can I offer them right now? The good news is there is typically no cost involved when implementing a downsell strategy. This is an excellent way for any business to immediately increase both revenue and profits. Another excellent option to consider is bundling. Bundling is simply the process of grouping together certain products or services to create packages, which you then sell to your clients. The key is to identify products and services that have a low price point but a high perceived value. By creating bundles, you create an apples to oranges comparison between you and your competition. This effectively removes price from the equation. A final option to consider involves introducing additional products or services into your business. Unfortunately, most businesses don't have additional products or services to offer their client base. So you want to ask yourself, what other products or services could my customers find valuable? Once you make up a list of those offerings, go out and contact the providers of those offerings and set yourself up as an affiliate and negotiate a referral fee. These 6 options can help you sell more stuff and make more money. Just start with one, implement it, make sure you generate a profit from it, and then implement another. Most of these require very little time and no money to implement. Option 3 for increasing revenue is to lower your break-even point. The definition of break-even point is the revenue level at which the gross profit pays the overhead costs of the business. In other words, it's the amount of revenue your business has to make to pay all the bills. Finding your break-even point is actually a very simple process. You only need to consult 2 numbers on your P&L, your gross profit percentage and your overhead. The formula for break-even is your overhead divided by your gross profit percentage. So in this example, it would be $60,000 divided by 0.4, which equals $150,000. But is that right? Well, let's plug that figure into our P&L and find out. We know our revenue is $150,000, and we also know our gross profit percentage is 40%. By knowing those 2 numbers, we can calculate the others. We multiply our 40% gross profit percentage times our $150,000 revenue to find our gross profit, which is $60,000. We can quickly find our COGS by subtracting our $60,000 gross profit from our $150,000 revenue, which equals $90,000. Our bills are our bills, so our overhead stays the same at $60,000. Now we can find our net profit by subtracting our $60,000 overhead from our $60,000 gross profit, which is 0. That confirms our previous calculation that this company's break-even point is $150,000. But why is it important for us to know that? Well, there are 2 critical reasons. First, your gross profit is what pays all the bills in your business. When you hit break-even, you're paying all of your cost of goods sold plus your overhead. Now, you're not making any money at this point, but you aren't losing money either. But remember what this training session is all about: increasing your revenue. When you hit break-even, you're now making 40% on every dollar of revenue. All of your overhead is paid for at that point. So the only cost you now have left is your cost of goods sold. From this point forward, this business owner gets to keep 40 cents of every dollar of revenue. Check out this visual representation to better understand the principle of break-even. Notice we have a total cost line and a total revenue line. The intersection point represents break-even. The green shaded area to the right represents increasing profit. Now, we said that we can increase revenue by lowering our break-even. If we can cut our total cost and move our break-even lower, look what happens to our revenue. Now, there's one additional factor to consider here. Remember earlier we said that option 1 for increasing revenue was to increase prices. Doing that affects this diagram in exactly the same way as lowering costs. But we also said in a previous lesson that COGS doesn't exist if there is no cost to deliver what you sell. Now, this is common for professional service providers listed here. This obviously affects their break-even point. Their visual representation looks like this. Their break-even point is equal to their overhead cost. Once they reach it, everything else is profit. So for professional service providers, they need to focus on increasing revenue and cutting overhead cost. Now, option 4 for increasing revenue is to learn how you can leverage your P&L. For example, what would benefit us the most? Lowering our overhead versus increasing our revenue. Well, let's try lowering our overhead by 20% and see what happens. Let's begin with our standard template. Now, we said we'll lower our overhead by 20%, so our revenue, COGS, gross profit, and gross profit percentage remain the same. Our overhead drops 20% from $60,000 to $48,000, which increases our net profit from $60,000 to $72,000. Now, that's a $12,000 increase in profit, but that's not and increase in revenue. How much increased revenue would be required to generate $12,000 in increased profit? Well, remember the formula we used earlier? A 40% gross profit means that for every dollar in sales, only 40 cents is profit. So let's divide our $12,000 profit by 0.4 and we get $30,000. So to achieve $12,000 in increased profit, you would need to produce $30,000 in additional revenue. So for every dollar reduction in overhead cost generates 100% of that amount to your bottom line. But every dollar of increased revenue only delivers 40 cents. That means reducing overhead has a 250% greater impact versus increasing revenue. Increasing price and cutting costs always returns 100% on your bottom line. Now, option 5 for increasing revenue is to use exponential growth. This goes back to what we covered earlier in this session. Remember, there are only 3 numbers in the P&L to focus on: revenue, COGS, and overhead. You want to impact all 3 of these numbers as much as you can, as fast as you can. But even small incremental impacts often produce dramatic results. In our previous example, we demonstrated the results of a small 5% impact on these 3 areas. That resulted in our net profit jumping from $60,000 to $87,000. That's a $27,000 increase on our bottom line, and best of all, there is 0 cost involved, and impacting all 3 of these areas can be done in less than a week. Exponential growth is a no-brainer way to increase revenue and profits, and every business should be taking advantage of this fundamental principle. Now, our 6th and final option is to perform a thorough examination of your accounts receivable. We felt this was so important that we needed to bring it to your attention, even though your accounts receivable is found on your balance sheet versus your P&L statement. A few years ago, my business partner told me something that has stuck with me ever since. He said, business owners drive new accounts, they follow up with their new accounts, they painstakingly close their new accounts, they pay commissions on their new accounts, fulfill on their new accounts, pay staff that fulfill on their new accounts, pay for wear and tear on equipment for their new accounts, and then forget to collect their money. I hope you don't fall into this bucket. If accounts receivable is a foreign term to you, then let's define it. It's the amount owed to a company resulting from the company providing goods and/or services on credit. Some common examples are businesses that give their customers a specific time frame to pay their invoice, such as 30 or 60-day terms. This ties up your funds over that entire time frame. So here are some quick tips to help you get your accounts receivable under control. Begin by itemizing your accounts receivable so you know who owes what and when. Review and prioritize those accounts based on past payment history. Call all past due accounts. Often they simply forget it's due. You can certainly email them and follow up with a written invoice, but if you want immediate and effective results, pick up the phone. You will find the majority were simply busy and have forgotten all about you. A simple reminder is often all it takes. Set up a tracking and notification system. There are a multitude of these listed online. Examine net terms, 30 days, too long. We recommend you make a due on receipt with a 2-week grace period. If someone does fail to pay, and they will, consider a collection agency. They take a percentage of collections, typically 30%, and they do all the work. People will take advantage of you if you let them. When you provide a product or service, you deserve to be compensated. Request payment upon delivery and give them a 2-week payment window so you receive compensation in a timely manner. You deserve it. So to recap, there are 6 options to increase your revenue. Increase your pricing, sell more stuff, lower your break-even point, leverage your P&L, use exponential growth to dominate your market, and itemize, review, and track your accounts receivable so you're paid for your efforts. Now next up, we'll go in depth on the factors that directly affect your COGS. You now have a handle on the ways to improve your revenue. So now let's shift our focus and help you begin to lower your cost of goods sold. We're going to reveal to you the 6 factors that destroy your business's ability to make money and then we'll show you how you can eliminate those 6 deadly factors from your business forever. Until then, here's to your success.